Right, so we've got a topic of talking about the future, about talking about the decade starting in 2020 and opportunities. So it is a bit of forecasting, a bit of predictions. So the way we approach investments is we don't try and predict what's going to happen in the economy and then decide we're going to buy these shares or not those shares. Some people do that. That's not our philosophy. What we do is we try and find companies that we think are cheap. They're trading at prices less than what the companies are worth. And if you own businesses like that in the long run, you tend to do quite well. So it's a bit of a different approach. And similar to that, that's kind of how I'm going to approach this topic. I'll give you some pictures and some snapshots on where we are as an economy and where we are as a market. And I'll put it in context with the global market. Right, so we've seen many headlines like this. This is actually from last year. It could have been, I'm sure there was a similar one last week as well. I'm going to save you some time and give you a spoiler alert. If you go on Bloomberg on their website and you read this article, it doesn't actually tell you. Like the journalists don't have the answers. And the reason is no one really knows. So there's a reasonably good chance, I guess, that we will be downgraded. No one really knows. But even if we do, it's hard to tell what will happen, right? So we can look at different countries where they've been downgraded. Sometimes it's been quite bad. Sometimes it's really been almost a non-event. So it is hard to predict. What we can say is if we look at how South African assets are being priced, so our government bonds, for example, people are really already pricing in junk. So to a large extent, we think the markets are already pricing as if we are being downgraded to junk, which would suggest that if it does happen, it's probably not a big event. Maybe there's some volatility and the rand goes out a bit and comes back, who knows? But it's unlikely to be a huge event, but we'll have to wait and see. On this week's budget, I was quite pleasantly surprised. I thought it was quite a decent budget. Maybe I had low expectations, I don't know. So this is the big thing Moody's are worried about. If foreign investors and ratings agencies, they have to decide, are we going to lend money to these people in South Africa? Are we going to get our money back? And the big thing they worry about is these people have a lot of debt. So our government debt to GDP is about 60%, which is quite high. Obviously, there are other countries who are higher. A lot of the developing of the first world countries are actually a lot higher. And even for an emerging market, there are others who are higher. So it's not complete disaster, but it's pretty high. And the worrying thing is a trend, right? So if we think we're starting this new decade at a pretty high level of debt, when we started the previous decade, we were in a much better situation. So we were kind of at a very low debt level, and we've taken on more and more debt. And it actually hasn't helped us grow that much, but now we're in not a great position. And then we spoke about Eskom and all these state-owned enterprises. So interestingly, if you think, okay, government's going to have to bail out Eskom, there's no way they can stand on their own, that's another 10 percentage points. So that takes us from 60% to 70%. So it starts getting a little bit worse. So it's really this trend that people are worried about. And the big thing is obviously we need to cut these government expenses, or we need to raise more taxes. Raising more taxes is going to be hard. Cutting expenses is also hard. So this cut in the wage bill, for example, is quite an important step. We'll have to see if it's enough. So that's the if you want to call it the balance sheet of the government. What about the income statement? So this is that deficit you always read about, the 5 or 6% fiscal deficit we have on a government level every year. The government gets tax revenue, it has expenses. That's the shortfall. Let's call it 250 billion rand a year. So it's a big shortfall. You don't have to break even because you are growing and you can raise taxes, and most governments don't break even. But it's quite a big gap, right? That's quite a scary number. So this puts into context what Mr. Mboweni talked about when he said they want to cut government the wage bill by 40 to 50 billion rand a year. So yes, it helps, but if you go from there to there, it's still quite a big gap. So that is a concern. And then the last part of this puzzle is Eskom and the other state-owned enterprises. Eskom is by far the biggest one. So I've just taken the cash flow for Eskom. So they've got revenue, and then they've got expenses, and they have to spend capital expenditures on building these new power plants and interest and all these things. And every year they lose, call it 40 billion rand. So that's pretty scary. Part of that, of course, is they've built these new power stations. So that's about 20 billion rand. So if we can hopefully finish Medupi and Kusile, which I think they're almost there, we'll see, that number does improve a little bit, but you're still short by, call it 25 billion rand a year. And then even if government writes off some of their debt, for example, or takes that debt onto the national balance sheet, you're still maybe not even at break even. So it's a very hard situation. So Mr. Underrater gets paid a lot of money. I would not want his job. He's in a tough situation. On the one hand, you think they have to reduce the debt and they probably have to put up electricity tariffs. But then on the other hand, you can't do that because then demand decreases and people can't afford the tariffs. So it's a very tricky situation. So we do have some serious economic problems we need to solve. It's not a completely hopeless situation, but it's not something we're going to solve overnight. It's going to take a few years, even if we do all the right things. And that's, I think, what the ratings agencies are also worried about. So if we go to the markets, and Max also spoke about some of these numbers, if we just look at the last few years, and this is not news to any of you, the market performance has been disappointing in South Africa, right? So if we think about the last 1, 3, 5 years, the JSE's given you sort of roughly inflation, a little bit better than inflation, which is not great. That's obviously disappointing. If you were in cash or bonds, you did a little bit better, but not great. Obviously, those are the grey bars. So you've got kind of 6, 7, 8% if you were in cash or bonds, so still not amazing. And then obviously, if you were invested in the world market, you would have done better. But some of that is just the rand appreciating, and a big part of that is also just the US market that's been so strong. I've just shown also, for example, so our 3 big flagship funds, which some of you may be invested in. So we've got the equity fund, which is mostly shares, the balanced fund, which is like the middle one, and the stable fund, which is the more conservative one. So that's red, blue, and green. And then I've shown for each one their various benchmarks as well, just for interest. And if we look over the long term, as you would expect, the equity fund has given you the highest return, the balanced fund has been in the middle, and the stable fund has been at the bottom. So I've used our funds, but you can look at other people, and the kind of relationship is similar, right? And that's what you would expect. So if you're taking more risk and you're accepting more kind of volatility in your returns because you own more shares, you would hope to get a higher return over the long run. And that has been true in the long run. But in the shorter term, and even 5 years, which is not that short, it hasn't been true. So the picture is the wrong way around. The red one should be there. It's at the bottom. And that's been frustrating for many investors, naturally. So even if you've done better than the benchmark, it hasn't really mattered that much because you've been worse off investing in shares than you could have been investing in a balanced fund or a stable fund, or the best thing would have just been to in hindsight, put your money in the bank and in a fixed deposit, and you would have slept soundly at night and you would have actually got a better return. So that's obviously a very frustrating situation, and I'll come back to what I think returns will be from here, but clearly the last while has been disappointing. It is quite unusual to have a 5-year period where this is true. So we've kind of gone back and looked at the data, and it's 1 or 2 times in the last 50 years where you've had a situation where over a 5-year period, shares have given you a worse return than you would have had in cash or bonds. So it doesn't happen often, but it can happen, and it's obviously frustrating. And naturally, as humans, we tend to focus on the recent past. So we tend to say, like, the last 5 years have been like this, surely the next 5 years are going to be similar, and we kind of forget about the longer term picture. But I'll get back to that as well. Just step away from South Africa for a second and look at other places in the world. So everyone's very negative here. The markets have been tough. Things aren't going well. If we look at some other parts in the world, it's actually the opposite picture. So this is the share price for Tesla, which some of you have probably read about. You can't see the numbers, but you can see the line is up a lot. So the share price is up 3 or 4 times in the last year. People are extremely optimistic. So this is one of the most popular stocks in the US. The market cap is $140 billion. It makes no profits or cash flows. It's actually negative. I mean, I think it's overvalued, but I might be wrong. I haven't looked at it closely. But I think the more interesting thing is people are willing to take a lot of risk. So in the US, things have been going well. The markets have been sort of doing very well. People are willing to almost throw caution to the wind and say, this thing could work. It's not making money at the moment, but maybe in 5 years it will. So we're willing to take that bet. We're willing to take a lot of risk and not really worry so much about the downside. So it's a very different mentality to what we have in our market at the moment. I mentioned earlier the US market has really been the place to be. So since the financial crisis in 2008, most global markets have done better than South Africa, but not that much better. It's really the US, which is more than half the world market, that's done phenomenally well. So that's really been the place to be. And valuations in that market are quite high at the moment. So some of those companies have very, very big market caps if you just look at them sort of in dollars. And it's interesting, I've just shown a few comparisons. So this just compares the free float, so all the shares you can buy in a market. So you can buy the entire stock exchange, or all the listed companies in Mexico for $140 billion, or you can buy Netflix. So you can buy one company or the whole Mexican stock exchange. Or, for example, you can buy the entire stock exchange in India, so all the listed companies, or you can buy Facebook. So these companies are really, really big. They're on big valuations, so yes, some of them make a lot of money, but yeah, it's interesting how big the numbers are. So I've mentioned a few times that our market hasn't performed as well as the US. So you can look at the last kind of year, 3 year, 5 years. But I've also shown the UK market as a comparison, so the grey one. And if we look at 5 years, the UK market's not been that great either. So they've done better than SA. This is all in dollars, so it's all comparable. But it's really the US market has been the one that's been the standout performer. But that's over the last 5 years. What about if we look over a longer period? Because like I mentioned, we tend to just extrapolate the recent past. So if you look at some of the really long numbers, and you can actually get the data, and it's fairly reliable. So if you look at 20 years, 50 years, 100 years, the lines are very, very similar, which is very surprising. I don't think people would have expected that if I asked you to guess kind of, over 100 years, which has been the best market. You wouldn't really have expected this. And again, it's all in dollars, so it's all comparable. So over 50 years, whether you invested in the South African stock exchange, in the UK, or in the United States, your returns were basically the same. There's no rule that says it has to be the same, right? It doesn't have to be the same over the next 50 years, for example. But it is interesting that over the long run, it's been quite similar. But you can see how investors are behaving. So people are they're not looking at that, right? People are looking at this. So whether you are South African, some people in South Africa feel, I shouldn't be investing in the JSE at all. I should put all my money in the US because that's the one that's been doing well. But that's really just extrapolating this last 10 years. So why are people so optimistic about the US? So I've mentioned the markets have done well and it's been a good place to invest. This is the NASDAQ US Tech Index. You can look at the last 20 years and it's basically been a straight line up. And there's not even that much volatility. So it's been a very smooth and very pleasant ride if you've been invested in that market. So you can see why people want to invest there, right? Because you want to kind of be in the place that's going well and where your statements are showing your money is increasing every month. So there's really, if you've been investing in this market, there's really not much. It doesn't feel like you have to worry about the downside because there haven't been, until recently, I guess, big corrections. Even 2028, 29 is sort of a blip on this chart. But obviously, it doesn't mean this needs to continue, right? And it doesn't always continue in the same way. So you had a similar picture if we go back and just note the scale. So I've just shown you the 90s. So for the same market, the NASDAQ in the 90s, for a long time, it was kind of a similar picture when you had the run up to the dot-com bubble and things were going well and you had very, very little volatility and the market was going up and up and up. And then obviously, eventually, you had a very big correction. So I'm not saying the same thing will happen today. We don't know what will happen in the future. But the mentality is very similar. So people in the United States, the market is very expensive. It's been going so well. People are not worried about the downside. They're really only thinking about the market is surely going to go up and up and up, and it's surely going to keep giving me 10, 15% a year return in dollars, which history would suggest is not a good assumption to be making. I've mentioned valuations in the United States, so this is just the price-earnings ratio is one way to measure the valuation in the US. It's the second most expensive it's been, basically, except for the dot-com bubble. So it's on a very high multiple. Yes, things have been going well, but typically when you buy assets on a high valuation, that tends to suggest your returns from there are usually not that great because you've got a lot of downside, really. If valuations just go from this very high level to kind of a middle level, you can actually lose quite a lot of your money. So it is quite a dangerous position to be. And then lastly, on this issue of comparing South Africa to the rest of the world, I've just shown the returns of the JSE versus the world markets. So there was actually a time when we were doing really well, and then the last 10 years, as I'm sure you know, we've really just consistently been underperforming world markets. And a lot of this is the things Tien spoke about, so kind of the own goals we've scored in our economy. But actually a lot of this is really just broader emerging markets type things. So many other emerging markets have a very similar picture. We're not a complete outlier. Some of this is just a function of the US that has done so well, and we've just lagged that performance. And then to close out this part, why am I speaking so much about the US? So, I mean, most of us are primarily invested in South Africa, right? But as I think Max also mentioned, so South Africa is a very small fish in the global market, in the global stock exchange market. But investing is a global game, right? So people do look at opportunities in different markets. And it is interesting today where if you're a global investor, you can invest in the US market, which is extremely expensive, but then you have opportunities to invest in markets like South Africa and other emerging markets where assets are actually quite attractively priced and actually trading at low valuations. So that is quite interesting if you're thinking, where do I want to invest my money today? And in light of this picture I showed earlier, where returns in the long run, the very, very long run, have actually been quite similar in different markets. So if you're thinking today, if they think over 50 years, the returns might be similar in South Africa or in the US or in the UK, do you want to invest in the one that's at record high valuations, where things have been going well, or do you want to invest in the market where valuations are actually quite low and things are actually very tough and people are very depressed? I would choose the latter. It doesn't mean put all your eggs in that basket. Obviously, you want to diversify. That's definitely a good thing to do, because these things can take quite long to kind of balance out. But it certainly seems much more attractive, to me at least. Right, so if we come back to South Africa, and I'm going to give you a few kind of snapshots on where our market is, and then I'll conclude on kind of where I think where we're going from here. So I mentioned valuations are fairly high, or very low, sorry, in South Africa. There's different ways you can measure it, and it can get quite technical. A simple thing you can do is just look at the price-earnings ratio. That's the thing you read in the newspaper for the JSE. It's about 16 times at the moment. This is actually a few months old, so it's probably closer to 14 now. It's come down quite significantly. But the interesting thing is our market is so concentrated. We've got these big shares like Naspers and Richemont. We've got 4 or 5 shares which make up almost half the index. So if you look at averages for the JSE, they're extremely misleading. So I think they're almost useless, really. A better thing you could do is maybe look at the median. So it's just the middle company on the JSE, what kind of price earnings multiples are trading on. It's about 11 or 12 times. And we've generally found if you're buying a good company or even an average company at kind of 11 or 12 times earnings, that's a pretty decent price. Over the long run, you should be able to get a pretty decent return. So that's quite encouraging. You can look at dividend yield, for example. I've just taken out Naspers because it's so big. The dividend yield on JSE is pretty much 4.5%, 5%. Sorry, 4.5% excluding Naspers. So that's more or less your inflation rate. So you're already getting kind of inflation just from the dividend, and any growth is kind of growth on top of that. Something I want to mention here. So valuations at the moment are below normal for the JSE. There's certainly a lot of negativity priced into the market. A few years ago, this was very different. So if we go back 4 or 5 years ago, valuations were quite a bit above average, actually, for the JSE. So there was actually quite a lot of optimism priced into the market, whether it was by locals or by foreign investors coming into our market. It's hard to think now that there was optimism in the JSE, but you can look at the numbers, there was. So part of this low returns we've experienced over the last few years has been the process of correcting from a position of high valuations, so we were kind of richly priced a few years ago, to now being at low valuations. So that's quite a painful process, because shares have to come down, the valuations have to come down. It means returns have been low the last few years, which hasn't been pleasant, obviously, for all our returns, but it does mean the starting point is a lot better. So we know there's a very strong relationship between the price you pay for something and the return you ultimately get. So if today you're going into the market, or you already invest in the market at this kind of fairly low valuation, it would suggest that over the next few years, returns could actually be quite a bit more attractive. The other thing I like to do is think about sentiment in the market. So are people too optimistic, or are they too pessimistic? So we all know if you want to make money, you should buy low and sell high. But unfortunately, as humans, we essentially animals, and our instinct kind of forces us to do the opposite thing. It forces us to do the wrong thing. So when the market's going up, we get greedy, we want to participate, we want to buy, and we typically buy at the worst time when things are already high. And then when the market is going down, we get fearful and we say, I want to get out of here. Things are really, really tough. And then we sell, and we tend to sell at the worst time. And if you repeat that too often, that doesn't lead to a good result. So Warren Buffett has a saying where he says we should be greedy when others are fearful, and we should be fearful when others are greedy. So it's hard to do. It's something you need to force yourself. It doesn't come naturally, but that's what we try and do. And a related thing is it's useful to try and judge kind of where the rest of the market is. So other investors, are they feeling greedy? Then you should be careful. or are they feeling fearful? In which case you can be a bit more assertive and maybe take a bigger equity position, for example. So there's a few kind of things I like to look at, which just give you a bit of an idea of where the market is. So I've just shown the share prices for a few South African companies. So that's Shoprite, Truworths, Tiger Brand, City Lodge. These are kind of South African-focused businesses. A lot of them had quite high shareholdings by foreigners a few years ago, and you can see the share prices are all down kind of a half to two-thirds. So things are quite depressed, right? So South African shares are very depressed. Another thing you can look at is, are companies making new highs? So typically when you look at, in the newspaper, they have that 52-week high, like which companies are at the highest share price they've ever been. And what I've shown here is just the percentage of companies that are making new highs on the JSE. So at the moment, no surprises, it's basically nothing. It's a few of the platinum shares which are trading at new highs. But for no companies, people are really very optimistic, and the most optimistic they've ever been. Where if we go just a few years back, so 2014, 2015, actually most companies on the JSE were making new highs. So the market was kind of doing fairly well at that time. Companies were reporting fairly strong earnings, valuations were going up and up and up. So there was actually a fair amount of optimism at that time. Certainly today, there's not a lot of optimism. I don't think anyone would dispute that. Another thing you could look at is companies making new lows. So what I've shown here is just how many companies are making new lows over which periods. So of the top 100 companies on the JSE, about 35 are at 3-year lows. So the lowest share price they've been in the last 3 years. And you can go through the various periods. We've got about 30 companies making 5-year lows, 20 companies making 7-year lows, and so forth. And some of these, I think, are pretty good companies. So you can buy a company like Famous Brands or Woolworths at the lowest share price it's traded in the last 7 years. So if you think this is an attractive company, they've actually grown their earnings over this period, and you get to buy it at the lowest price it's ever been in the last 7 years, that could be quite an attractive opportunity. So for some of these, obviously, there's structural problems, or maybe something's changed and the future won't be good. But in some cases, this could be, in hindsight, quite a great opportunity. And the last thing on this topic of sentiment is, what you typically find is when, and not just in Africa, globally, when markets are depressed and everyone is negative, you tend to see a lot of companies delisting from the exchange. And you tend to see the opposite when things are going well. So when the market is sort of on fire, you see lots of new listings coming into the market. And interestingly, over the last 2 years, there's been lots of companies delisting from the JSE and very few new companies listing. These are some of the ones that have delisted, and it's for different reasons. So Pioneer, for example, was bought out by PepsiCo, or Clover was bought out by Israeli companies. Some of these companies are cases where management are taking their company private, or private equity buyers are coming in and delisting the company from the JSE, which is quite interesting because normally private equity valuations are lower than listed valuations. Now you've actually got the opposite situation. So in various cases, you've got buyers coming in. So the Pioneer, for example, where this is a big global company, they think that they want to be in SA for the next 10, 20 years, and they think this is a good place to be buying the shares, which is it's quite interesting. It tells you something about sentiment. Just on Pioneer, because I thought some people here might find it interesting. So Zeda obviously owns some Pioneer shares as well. And if you look at a company like Zeda, it's trading at about R4.50 a share. They've got these Pioneer shares, which they're going to sell to PepsiCo, and the deal's already been approved. It's just going through the last 2 steps. And you're going to get almost R4 just from the Pioneer shares you own, which is interesting because the whole share is trading at R4.50. And they've got other assets as well. They own some Carp Agri and Capespan and Zart, the seed business. So the company is probably worth quite a bit more than just the Pioneer shares it owns, but the market's not really interested in that at the moment. And what you also find in times when the market is quite depressed, typically these holding type companies like Zeda or Rembrandt or these type of companies trade at discounts, where people don't want to be in these kind of a little bit more complicated structures. So these type of shares can get quite depressed, but that's in a way good for us because it does create opportunity as well. I mentioned Woolworths, so I'll just use an example of kind of a South African share, which is maybe quite an attractive opportunity at the moment. So many of us buy overpriced biltong, or my wife buys sliced mangoes or something at ridiculous prices at Woolworths. they've built a phenomenal business, right? I think most people would agree Woolies Food, that's a good business. It's quite sticky. Most people won't change, even if things get quite tough. They've grown earnings phenomenally over the last 10 years, so they've built quite a good business. Then they made a very stupid mistake. They bought a department store in Australia called David Jones, and they paid way more than they should have. So they've definitely made some mistakes. But they've paid for that. So if you look at the Woolies market cap, it was 100 billion rand. It's now 40 billion rand. So the share price is down more than half. But if we just ignore Australia, for example, we just think of Woolworths South Africa plus Country Road, it makes about 5 billion rand a year before tax. You're buying the whole thing for 40 billion rand, it makes 5 billion rand. And that's without Australia, so there's some debt and there's some tax and other things, so you have to count that as well. But it seems like a low valuation, right? It seems like a low price if you think this is a good business. So we certainly think it's attractive. It's one of the shares we've been buying. And the way the kind of mentality works at the moment in the market is because people are so negative, they're not thinking about what can go right. They're just thinking about what can go wrong, which is natural when things have been tough. But in the case of Woolworths, for example, so we think it's a solid business. You're getting it at a good valuation. They've got this department store in Australia. It's breaking even at the moment, but it might work. Like, I don't think it necessarily will, but there's potential upside. But people don't want to think about potential upside given kind of the current market environment, which does create opportunities for investors as well, I think. Just a second example on kind of shares in South Africa. So the one sector that's been doing well is the platinum sector, right? So you may have read platinum and palladium prices are kind of at record levels. So the platinum companies have been doing very well. Impala Platinum is one of those examples. The share price is up, I think, almost 10 times from the bottom now. So it was very depressed. But the reason I showed this is for quite a long time, the platinum sector was very depressed. So things were just going one way, valuations were going down, companies were struggling. But sometimes things that are very depressed and companies that are really struggling, sometimes things actually do change. And it was very hard to see at this point what would change, but then it did change suddenly and things actually went quite well. So I don't think necessarily the same will happen for all the other South African companies, or maybe not to the same extent. But you do get to a point sometimes where valuations are so depressed, where actually you just need a little bit to go right for share prices to respond in quite a dramatic way. The South African listed property sector seems very cheap, so valuations are very low. You can buy most of the listed property shares at kind of a 10% plus dividend yield. The average is around 10%, which is a very high dividend yield. If you look at listed property in other countries, or you look at bonds, or you look at bonds in the developed world, 10% return just from the dividend you're getting seems quite high. So it seems like, what's going on here? Is it very cheap? We haven't really been investors in the property sector, so we're a little bit skeptical about this one. I've just shown one here as an example. So Hyprop is one of the biggest ones. They own Canal Walk and some of the other big malls. A few years ago, the Hyprop share price was 150 Rand. It's now about 50 Rand, so it's down about 2/3. So what changed there? It was trading at a dividend yield of about 4%. It's now trading at a dividend yield of 12%. So a few years ago, people thought, 4% dividend yield, that's quite low, but we're happy to accept that because we think the dividend's going to grow. Every year it's going to grow more than 10%, just into perpetuity, which in hindsight was not a good assumption to make because that hasn't happened. So what went wrong? They put up rents too much. Most tenants, if you own businesses or people who own businesses, will tell you their rents are actually coming down now because rents are too high. The landlords have basically been too greedy in the past, and now they're having to correct that. And also they played some funny games with financial engineering and derivatives that they used to boost their distributions, and now they're having to unwind some of those things, which is also hurting them. So the property sector is the one place where we think there's maybe still a bit of pain to come. So we're looking at it, but it's not, we think, a kind of an obviously great opportunity. Okay, then just to conclude, so I talked about the US market quite a bit and the world markets and about SA. And just to reiterate, I think it is important that we realize in most of the world there aren't many cheap things you can buy. If you're a global investor, you can buy bonds in dollars or in euros giving you 1%, 2% return. So not great. You can buy shares in the US at close to record high valuations, fairly high valuations in Europe. But then you have emerging markets broadly and South Africa as well, where valuations are actually quite low, below normal, which is quite unusual. So we think South Africa is from a valuation point of view quite attractive at the moment. Yes, the economy is very tough. I don't know when it will turn. Quite a small improvement in the economy could have quite a big impact on the stock exchange. Even if things just kind of muddle along and we grow 1%, 1.5%, pretty possible that we could have quite attractive returns from the JSE. But in the short term, it's very hard to predict, right? So in the next 6 months, in the next year, year and a half, it's very hard to predict. But typically when you're buying at low valuations, barring a complete disaster scenario, returns tend to be quite attractive. So yes, we have to worry about structural risks. You know, if something has changed in SA, Eskom, all these things. So that's something we think about. But I would say we're kind of cautiously optimistic. Okay.